in the last year, we have all faced unprecedented times. And so Joe, Andrew, and I do want to welcome them. So I do have Andrew Paoni, who is a partner of the Wealth Management and Investment Strategy. I also have Joe Connell on the line with us today. And Joe is the retirement plan, is partner of the retirement plan services area. And again, I'm Marie Marks. I am a senior retirement plan specialist with Sikich. As we've gone through the last year and we've talked about what our clients have faced and the unprecedented challenges that all of you have faced, one of the things we found is how can we change or take some of what we have learned and make changes going forward? And then we found that Pete the Planner has already done this. He has taken some of the things that have happened and he's kind of unraveled them and found a way to say, instead of facing what we face through the challenges, how can we take that, press reset, and build stability in our own personal lives now and going forward? So with that, I would like to introduce Peter Dunn, who is also known as Pete the Planner. Pete is the CEO and founder of Your Money Line and Hey Money. He's also a USA Today columnist and the author of 10 books. He is the host of a popular syndicated radio show and podcast, The Pete the Planner Show, and has appeared regularly on Good Morning America, CNN Headline News, Fox News, Fox Business News, as well as numerous other nationally syndicated radio and television programs. With that, we welcome Pete to our event.
Good afternoon, everyone. It's Peter Dunn, Pete the Planner. Glad to be with all of you, and Marie and Joe and Andrew. It's nice to be with you. Today, we're going to talk about your financial life. We're going to briefly revisit 2020. At least I warned you. We're going to revisit the financial realities of 2020 briefly. And then we're going to take a look at what's happened so far in 2021. And we'll talk about the rocket ship that is our economy and how you can make sure with your stability plan you don't get left behind. Of course, thanks for the sponsorship for today's event. Of course, the good folks at Sikich, Fidelity, American Century Investments, and One America as well. Okay, so here is the agenda specifically. We're going to talk about how do you go from a year in which we were forced to react to literally everything in our lives. How do you go from a year of reaction to a year of being proactive? That's where we're going to spend quite a bit of time here to start. Then we're going to talk about stability. Now, stability always feels like a feeling, frankly. It feels like, do you feel stable? Yeah, I feel stable. It's not that from a financial perspective. It's a quantitative financial destination. That sounds fun. There are 10 factors of financial stability. So by the time we finish up today, I think you will know quantitatively, you'll have a number, how stable are your finances? So you will know that. And then the crew from Sikich will come back and we will answer your questions. If you have any questions in the meantime, put them in the Q&A box and I will do my best to answer them as we go. Feel free to pepper them in there. They just become part of the show. I won't necessarily save them. I'll just go right to them. A lot of people don't realize how much they actually accomplished in the year 2020. They really don't, because we were constantly forced to adapt. In March of 2020, the bad news started trickling in, and I'll be honest, it didn't stop through the end of the year. And so that's to say many of us not only spent through some emergency funds, had to go into a little bit of debt, we forwent income opportunities and the like. So all things considered, we actually accomplished a lot. Our plans, our emergency plans worked, and now it's a matter of sort of refocusing that intention to make sure that we're not constantly on defense, but that we can be more offensive minded as it relates to accomplishing our financial goals. Now, that's where we're going to spend most of our time today, exactly how to do that. But it does make me think about this video I want to share with you here briefly. This video, to me, is now the perfect visual representation of the year 2020, what you and I went through. It's actually a video of my son at a Greek festival about 4 or 5 years ago. He was 5 years old and he wanted to ride this pretty intense looking ride, and I didn't really want him to because it looked like it could hurt him. He convinced me otherwise and I videoed it, and I'm going to share it with you now because, again, this is the perfect visual representation of the year 2020. Ladies and gentlemen, this is Ted Dunn.
Get on the pad. Duck. Be ready to jump.
Here comes March of 2020.
This is a big time. Oh, he's down. Oh, he's taking out another girl. Ted, get back on the pad.
Here comes
Duck.
May of 2020. We didn't quite know what was going on yet.
Jump. Get on the pad. Duck.
Here's reacting to July of 2020 when things still weren't better.
Jump.
It's still surviving. Here comes September of 2020.
Ted, jump.
It's getting worse. My parents is getting worse.
You can get out of the way if you want.
Here comes election week / month.
Ted, this isn't going well, buddy.
Here come the December holidays away from our family. And finally, here is the first week of 2021. All right. So a couple notes for you. He is out of the concussion protocol, which is good. And number two, apparently I'm not a good parent. That's all right. Okay, so what happened in 2020 is we got split into three groups of people. So all the people on this call right now, we are represented by three different groups of people. The first group of people created in 2020 were about 25 to 30% of Americans. And it's people who were significantly financially impacted in a bad way by COVID-19 and the recession. So 25 to 30% of Americans, severe impact. Loss of hours, loss of income, loss of job, loss of income opportunity. Sometimes it's not a matter of you lost hours of your job, but maybe you're an incentive-based or variable compensation-based employee, and those opportunities just didn't present themselves in 2020. So that hurts you because you were used to getting a certain level of income. That income did not come. So therefore, you are part of that 25 to 30%. Now, about half of the people who were affected this significantly by COVID-19 and the recession have recovered, but there's still quite a few people triaging their financial challenges in our economy right now. The second group of people is the largest group of people. And by the way, this group of people persists in sort of their association. And here's how it works. 55 to 60% of Americans were not necessarily severely impacted by COVID-19. However, they don't have financial stability, and they didn't have financial stability, so they were always on the verge of trouble. Now, oddly enough, this group of people existed prior to this pandemic and recession and will exist certainly after the pandemic and recession, and we're going to spend most of our time today talking about why that is. So this is the group of people who it doesn't outwardly feel like anything's wrong, but there's just not a lot of financial foundation to build on. And then, of course, the third group of people, it's about 10% of us on this call, 10% of the population at large. It's people who were not significantly impacted financially from COVID-19 and the pandemic, and they happen to have a lot of stability. Of the 10 factors of financial stability that we're going to go through today, they have strength in almost every single category. These are the folks that should be focused on generational wealth. When you talk to people like Andrew at Sikich, these are the sort of people that want to go in there and maximize returns and maximize opportunities and maximize their understanding of how their financial situations work. All right, so the key to all of this, though, there has to be one thread that runs through all three of those groups, and that thread is stability. I've been doing this for over 2 decades, and it wasn't until I experienced 2020 that I really understood how important financial stability is in the lives of Americans. In fact, the reason for this is, the reason why it has taken me so long to understand this is, like many Americans, I've always measured my financial stability based on comfort. Right? If you were to come up to me and be like, hey, how's it going? I would think about my life. I would think, well, my vacation wasn't bad this year. We can go out to eat kind of whenever we want. My car is relatively new, or my house payment doesn't bother me. Yeah, we're good. Yeah, we're stable. But everything I just described to you is more of a lifestyle measurement. It's a lifestyle evaluation. I'm saying, yeah, things are easier than they used to be. That's what I'm saying. And I think most people self-evaluate the quality of their financial lives on that same plane. They just say, I can't complain. Yeah, we're good. But there's actually no way to measure that because it's a very fickle, abstract feeling. I would also argue the reason people do this, and likely why you do this, is because you simply didn't realize there is a standard way to measure your stability. The less polite way to say that is you are ignorant to the fact that there is a way to measure how stable your household is. And I would argue that prior to the pandemic, had people measured their stability and they really knew quantitatively where they stood from a stability standpoint, it would have informed them as to what was about to happen to them from a quality of life standpoint as the recession and pandemic took hold. Finally, and you want to talk about not fun things to hear. The biggest issue with using comfort as your guide for too long is that oftentimes you will get the lifestyle and the result you want, but it's not necessarily because you did it the right way. Therefore, you were lucky that nothing bad happened. If I were to jump in my car at the conclusion of this event and go grab lunch or something and not put on my seatbelt, and I were to get to my destination and all of a sudden I feel justified because who needs a seatbelt? I didn't wreck, I didn't need one. No. I'm not validated in my lack of use of a seatbelt. In fact, the lack of use of a seatbelt is a problem. I was wrong. I was simply lucky that nothing bad happened. I find that high income earners, really intelligent people, people with assets, consistently put themselves in this echo chamber of not doing it the right way, but still getting reasonable results and then convincing themselves that they're doing it the right way. And the problem is not in the moment itself that occurs. It's what happens when adversity and what happens when life gets in the way of your financial existence. This is why I like stability better. Because if you have a layer of stability, which we're going to measure with numbers, that will bring you comfort. You can get right back to that great vacation and going out to eat and driving a good car and not having your house bother you. But you can never comfort your way to stability, but you can stabilize your way to comfort. It's a matter of doing it in the right order. The second thing, and I happen to like this, is it allows you to take appropriate risks. Now, I don't mean market risks, the risks you talk about with your investment professional. I mean risks like retiring early, sending your kid to college, starting a business, buying a vacation home. Those are the types of risks I'm talking about, where you go outside of the stability to push yourself a little further, to set a goal and go after it. That is a risk. I think with stability, you can set the right amount of risk. Now, I don't want to get ahead of ourselves here, and you know what, I'm going to ask Andrew about this here in a little bit, but what you saw in 2020 is that people wanted to push their financial lives further when they didn't necessarily have stability, and it manifests itself in pretty interesting ways. You know, the craze that is cryptocurrency and alternative investing and the different meme stops like GameStop and AMC, all of these sorts of culturally significant, all of a sudden, financial decisions are a way that people are taking excess risk. And a lot of times it's people who don't have stability. So they're trying to short circuit the process and really, get after their financial life in a significant way without creating that layer of stability that prevents bad things from happening. But finally, here's why I value stability the most. I think it allows you, every single person on this call, to set a household standard or a group of rules that just become, this is what this household does. Now, sometimes people think setting rules makes your life harder. I tend to think that setting rules makes your life easier. If you have boundaries, if you have values, then you have to stay within those boundaries to get the life you want. So here's an example. Here, I'm going to share some of my household's financial standards, not because for any other reason that I need to give you an example, right? We max out our 401ks, okay? We have at least 3 months expenses set aside in savings account, and we don't use credit cards. So I'm not suggesting that those be your standards. I'm just telling you those are our standards. And I'm also here to tell you that they were our standards before they were our reality. The only reason I can say we can check the box on all three of those things now and we live those standards is because we made them our standards at the beginning when they were not our reality. We had to increase our 401k contributions. We had to build that emergency fund, and we had to abandon the use of credit instruments. Now, that's what we do. You can do something different, but I think you do yourself a disservice if you operate under the, well, anything goes. It's funny when you think back of whoever raised you, and you think about what they taught you financially, and what were the standards of the household you grew up in. That's a good way to get your head around this. When people say, well, my grandma always told me, or my dad always told me, and you can set those same boundaries for not only the adults within your household, but maybe even kids in your household too. So here's what's about to happen next. We're about to measure your financial stability. We're going to go through the 10 factors of financial stability that will help inform you how prepared you are for whatever life brings your way in the next 24 months or so. I happen to think that money magnifies you, right? The addition of money, the subtraction of money, it's going to take how resourceful you are and magnify that. So if you're not a very resourceful person, if you tend to make a lot of financial mistakes and you get a lot more money, whether it be through stimulus or bonus or a raise or whatever else, it's highly unlikely that you do something efficient and arguably practical with that money, right? That's why you see a lot of lottery winners really struggle. It's because just because you've got millions of dollars doesn't mean you're a resourceful person who has really good financial ideals. The other part is true as well. If you struggle financially and then all of a sudden, financial decision making, I should say, and you fall in hard times like so many people did in 2020, those challenges can be magnified and make your problems seem so much worse. So inevitably, here's what's about to happen. We're going to create 4 groups of people on this call. There's going to be one group of people who came into this call thinking, you know what, I feel pretty good financially. I'm just here to hang out with Marie for a little while, but I feel pretty good about my finances. Well, after we measure your stability, we may find out that your stability is not what we thought it was, and your stability is not what you thought it was. Therefore, maybe you've been in denial. Maybe you suffer from financial ignorance to how any of this stuff works. Maybe you're delusional as to what your reasonable expectations should be. There's another group of people on here that unfortunately will be created today, but it is reality, who came into this conversation thinking, man, I don't have the most stability in the world. And the numbers we're going to put together in just a few minutes will actually verify that. It will say, yeah, you're right. Maybe you are feeling defeated financially. And by the way, it wouldn't be out of the question for someone to feel defeated, despondent, and resigned right now after the year we've just been through. Yes, I think we're part of a pretty robust economic recovery, but that doesn't necessarily mean everyone's involved with that recovery. Some people are left behind. There is a bit of a K-shaped recovery depending on what industry you are in. You look at a lot of the unemployment issues that still persist and a lot of the jobs that are open. That doesn't necessarily mean that everyone is doing fine. So it's okay if you feel that way, and you shouldn't feel shame in it. It's just your current reality. Maybe you came into this call feeling really bad about how things were going, but this exercise we're about to go through will tell you, you know what, you're fine. Maybe you're just anxious about this or nervous or you lack confidence. I think the word of the year, other than most of the medical terms we learned in 2020 and PPE and everything else, could have been anxiety. The word of 2020 was anxiety, as we all battled financial anxiety and social anxiety and medical anxiety and work anxiety. And come to think of it, I'm starting to feel anxious the more we talk about this. So let's park that idea. Or you could lack confidence altogether as it relates to your financial situation, but that doesn't mean your financial situation isn't good. And the final group of people that we're going to identify here in just a moment are people who came into this call feeling pretty good about their finances, and I will be happy to help support you in that by showing you that the numbers you are about to find will tell you that you are doing a pretty good job. So you should feel confident, calm, and calculated. So what I'm going to do next is I'm going to give you the 10 factors of financial stability, and your goal is to keep track of your score. There are 10 possible points. I will tell you how you earn points. If I happen to confuse you as we're going through this, here's what I encourage you to do. In the question box, just type me your question, and I will just answer it on the fly, because chances are, if I did not communicate this well and you were confused, someone else on the call is also confused, and I need to clarify it for you. So just if you have a question, put it in the box. So here's what's going to happen. At the end of this exercise, you're going to add up of how many of the 10 points that you've earned. If you have accumulated 0 to 3, then I would say stability is very much still an issue for you, or shall I say a lack of stability. So you're sort of merely surviving right now. That's not as negative as it sounds. Surviving is much better than the other alternative. So there's no shame in beginnings. If you find yourself in 0 to 3, at least you are validated in the fact that that's your situation. The second group of people is where most people in this call are going to be. It's 4 to 7 points on this 10 question quiz, and you're in the middle group, right? If you have too much confidence in that, then you may miss opportunity. You may miss opportunity to strengthen your situation. If you realize that you're probably in the middle group because you're on your journey way to the top, that's fine too. Just understand, most people here are going to be in the middle group, and my goal upon the conclusion of our event is that you know specifically what you need to improve to strengthen that stability. And finally, there will be about 10% of people on this call that have 8 to 10 points in terms of their stability score. So let's get after it. Here are the 10 factors of financial stability. There are no wrong answers. They're just your answers. Also, do not cheat. Really, don't try to fudge this and get a higher number. The only person that's ever actually going to know your number is you. So there's no reason to misrepresent the truth, or, you know, if you think about if you weigh yourself on your bathroom scale, but you've learned how to like lift yourself up on the counter a little bit to subtract a few of those lbs. I've been known to do that to myself every once in a while. I don't know why. It doesn't help me. Here's question number 1. Has your income decreased as a household? Has your income decreased by 25% or more in the last 6 months? If it has, that's clearly a stability issue. Doesn't make you a bad person, doesn't mean you made a mistake. It just, if you're like, hey, I'm just trying to get my life together, our income went down by 25% in the last 6 months, clearly that creates stability issues. So if that's the case, if your income has gone down, yes, it has gone down, then you don't get a point here. If your income has stayed the same over the last 6 months, so it has not gone down or has gone down by less than 25%, you get a point, because that point is representative of stability. So there's question number 1. This is how we're going to do this. There are 10. This is 1. We have 9 more to go. So far, you either have 0 points or you have 1 point. Question number 2. Have you been late on any payments in the last 60 days? Or do you have any debts in collection? Sometimes people say, yeah, we're good. Now, look, we've got a couple old medical debts that we haven't addressed in a while, but they haven't called us in a while. That's not stability. Like that is instability. So you would not get a point if you have debts and collections, or if you are not current. Otherwise, you get a point. You get a point if you're current. You get a point if you don't have debts and collections. Otherwise, you don't, right? Okay, so those are the easy ones. So those first 2 are the ones that, if you were really damaged by COVID-19 and the recession, you will have known based on those 2 questions. From there, it gets a little more complicated. Okay, here we go. Number 3, what percentage of your income is fixed relative to your total income, including any commissions, bonuses, overtime, or variable pay? I'm going to leave this up here while I describe it because it's a little complicated. Let's say I'm going to use big round numbers, so don't get weirded out by the numbers themselves. Let's say your total income is $100,000 a year. 75,000 of that is base salary, and 25% of that is bonus or commission or overtime or something like that. That means that 75% of your income is fixed. 75% of your income is fixed. During tough economic times, and even during a recovery, the more of your income that is fixed, the more stable your finances are because you know what's coming in. The higher degree of your income that is variable, that you can't necessarily depend on, the tougher it is to create financial stability. So that is to say, if 75% of your income is fixed or higher, you get a point. If 74% of your income is fixed or lower, you don't get a point. So think of it this way. Sometimes people are like, well, I'm 100% commission, or I'm 50% commission, 50% base. It's not to say you've got a bad job. It's not to say you don't make enough money. But if you're trying to see how stable things are and how easy it is to rely on certain levels of income, you want a higher degree of fixed income. So there you go. Question number 4, and this is the one you expected. When we started this event, this is the one you knew was coming. What is your emergency fund balance? Okay. We do not measure emergency fund balances in these parts based on dollar signs. We do it based on the number of months that you can deal with. If 3 months or more of your expenses is set aside in a savings account or a checking account, you get a point. If you have less than 3 months worth of expenses set aside, you do not get a point. Here's how this works. Let's say it costs you $4,000 to live a month, right? You go to the grocery store, you pay your mortgage, insurance, everything. $4,000 is everything that it costs you. 1 month worth of expenses is $4,000. So to have 3 months worth of expenses, you would need to have $12,000. Look, if you need $4,000 a month to live and you have $10,000, I think it's great that you have $10,000. But I also know that you don't have the right level of stability I want you to have, which is 3 months expenses. I also want this money limited to very liquid sort of vehicles, things like savings accounts or checking accounts. I don't want you to consider your retirement money to be towards this emergency fund. Your retirement money is for the future. It isn't meant to help you with current emergencies. And that's where people find themselves in trouble from time to time. So if you have 3 months or more of expenses set aside right now, you get a point. Less than 3 months, you do not get a point. Okay. Now, Joe and Marie here from Sikich are your sort of retirement plan experts, and they help you with your financial future. Now, here's the interesting part about this. Unless you're putting the right amount of fuel into that vehicle that's going to drive you to the future, you're going to struggle, right? And so it's so important to know how much you're dedicating of your income now towards your future. What percentage of your income are you personally contributing to retirement savings? I think the threshold here is 10%. If at least 10% of your income that you are personally putting in, I'm not talking about the match, I'm talking about you personally. If it's at 10% or higher, you get a point. If it's less than 10%, you do not get a point. Oftentimes what people will do is they'll stop at the match. Like the company match might be 4%, so you put in 4%, they put in 4%, which gets you to a total of 8%, which is still not enough, and you're not putting in that 10%. For people in their 20s, typically, we like to see a total of 12 to 15% of your compensation going towards retirement. And that might be in the form of 10% you, 4% your employer, for a total of 14%. If you're hearing this idea for the very first time and you're not in your 20s, maybe you're in your 30s, which I'm not, 40s, yes, or even 50s, your percentages need to be higher than 10%. They need to be higher than 12 or 15%. And talking to the folks at Sikich can help you get on track of like, what is that number for you based on what you're trying to accomplish? The next factor here is, are you saving to a non-retirement account on a regular basis? Something like a 529 plan, which is a college fund for your kids. Maybe you're just putting money into a brokerage account or a savings account. But this is to say, not only are you putting money away for retirement, but you also are saving money on a regular basis. If you happen to be setting non-retirement money aside on a regular basis, you get a point. If not, you don't get a point. What is your total credit card and unsecured debt balance? Here's what I know about Americans over the last 9 months or so, is people actually paid down a lot of credit card debt, a lot. It's starting to rise again, but people did pay down a lot of debt. But what we know about unsecured debt, consumer debt, credit card debts specifically, is that it's a sign of instability. Here's what I'm not talking about. I'm not talking about car loans, I'm not talking about your mortgage, and I'm not talking about student loans. I'm talking about like store credit cards, major credit cards, personal loans, things like that. Less than $2,000 of those types of debts, you get a point. More than $2,000 of those particular types of debts, you do not get a point. And again, if you have a financial past, which is debt, it's a lot harder to manage your financial present and your future, which is, well, your financial future. Question number 8. We're almost there, everybody. You're doing a good job. Are you consistently making more than minimum payments on your debt? At some point in time, it's okay to carry your debts, meaning just make minimum payments and don't go deeper into debt. But when we're trying to progress and move forward financially, we want to make sure we're paying off our debts. When you pay off your debt, you increase your net worth just as though you were saving money. So if you're paying more than minimum payments on your debt, you get a point. If you're not, you don't. If you don't have consumer debt, you still get a point, okay? So if you don't have consumer debt, you get a point. If you're paying more than minimum payments on at least one of your debts, you get a point. And if you're just maintaining the minimum payments, then you don't get a point. 2 more to go. If you have student loans, will you have your student loans paid off within 10 years based on your current payment? If the answer is yes, you get a point. If the answer is no, you don't get a point. If you don't have student loans, then you get a point. One of the big things that's going on in our culture economically right now is that people are just consumed with student loan forgiveness. They both have enjoyed student loan relief within the last year because of the CARES Act and subsequent stimulus packages. There's an expectation at large that the current presidential administration may forgive student loan debt. And I'm not here to put judgment on any of that. I'm just saying culturally, there's this idea right now that student loan debt is a massive problem at $1.7 trillion and that people may seek relief other than paying it off. That's all great. And arguably, it's none of my business. But here's what I'm here to say. Until those things happen, you got to pay off your student loans. So if your student loans are going to be paid off within 10 years, you get a point based on your current payment. If they are not, you don't get a point. If you don't have student loans, clearly you get a point, okay? This also includes the student loans that you might have for your kids. The New York Times, I believe, this weekend, I don't even know what day it is. I believe it's Tuesday. No one really knows. I think on Sunday, there was an article in the Times about Parent Plus loans and how troublesome they can be. So that applies to those loans too. The stories are abundant. You know, people in their 50s and 60s having deep into 6 figures of student loan debt that they're somehow supposed to figure out in pre-retirement before they retire. It's really tough, and oftentimes they don't get out of that debt in 10 years either. Okay, final factor. If you happen to live in the Midwest like I do, this is easier to accomplish than for the folks who live in very expensive places. So if I'm going to frustrate you at all today, which is likely, this is probably the one that'll frustrate you, because sometimes it's not your fault. Sometimes it's not your fault that you spend a high percentage of your income, your take-home pay, I should say, your after-tax income towards your housing payment, whether it's mortgage payment or rent. If 40% or more of your take-home pay, again, that's your net pay, that's after taxes. Let's say you make $6,000 a month, you have a $72,000 income, maybe that ends up being $4,300 a month in take-home pay. If your mortgage payment or rent is higher than 40% of that take-home pay, you do not get a point. If it's 40% or less, you do get a point. People don't acknowledge all of the time that housing is such a significant decision. It's often the thing you purchase with the highest price tag over the longest period of time with the most amount of interest. It's a significant thing. I'm not here to say your house is a retirement tool. I mean, that gets a little strange. I will say the decisions you make around housing will significantly impact retirement. Not only do you not want to spend so much money on a monthly basis now on housing that you can't accomplish other financial goals, but ideally you would want to keep how long you'll have that payment in mind as you approach retirement. I mean, I personally take it a step further. Right? Our goal is to have our mortgage paid off by the time our kids go to college. So it just helps with cash flow there. Now, we're not doing anything unnatural, like pumping money into it to pay it off. We just structured our loan differently in terms of a 15-year mortgage as opposed to a 30-year mortgage to accomplish that. So we should have some scores right now: 0 to 3, 4 to 7, 8 to 10. So add them up. If you have questions around that, now is the time to ask. Just put that question in the Q&A box. I will be glad to answer it. Okay, here's where we are now. Why did we do all of this? Some of you are probably wondering that. Here's why we did all this. Because we want to know what area of your financial life needs attention. If you don't have an 8, 9, or 10, which it's unlikely that most of you do, then maybe we can look at those particular factors and use those deficiencies within those factors to figure out where your focus needs to be. Steady income is the first question, right? Steady income was this idea of is your income the same level all the time? Because it's a lot easier to run your financial life when you know what's coming in. Second one is, do you have the right level of income? Are you current on your bills? Never feels like in history has that been a more relevant question in the last 15 months or so. Do you have the proper level of savings that can help mitigate financial emergencies? Are you putting enough money towards your future? That was that retirement question. Are you putting at least 10% of your income away for retirement? And really, that 10% is the bare minimum threshold, truly. Flexibility. Are you, saving towards other financial goals like home ownership or your kids' college or retiring early? That's that question about non-retirement savings. Do you have the proper debt levels? Are you organized? When I talk about being organized financially, I think that manifests itself in, are your student loans paid off within 10 years? I think oftentimes a person can convince themselves that their education debts are not as important and they don't warrant being organized. I, of course, feel differently. Are you moving forward? Meaning, if you are in debt from a consumer standpoint, are you getting out of debt by paying more than minimum payments on at least one of your debts? And finally, is your housing situation under control? So that's what it is to understand what needs attention in your financial life. Now, I'm going to bring the Sikich folks back now. You guys are welcome to turn on your cameras and your microphones as we sort of dig in a little bit to the realities that you all see on a regular basis. Marie, I'll start with you. From a retirement plan standpoint, people tend to do a lot of their retirement plan savings through their employers. And oftentimes, if they are automatically enrolled, then that's the beginning of their relationship with retirement. Another element that is that people can be auto-escalated, meaning their contributions can increase on a regular basis. From the work that you do in the retirement plan space, is that the trend right now for employers to make those changes automatic, or are you seeing participants go in there and make the changes themselves?
I would say that most companies are trying to make it automatic, because when that happens, it pretty much sticks, and it's easier for the participants to follow that trend. They won't opt out. They'll just follow it, and when the money is being saved, it's easy. The first paycheck they might notice. After that, they don't.
Yeah, I agree. It does sort of take the pain out of it. If you never knew it was in your hands, then you don't miss it, right? That sort of thing. Joe, I wonder, as you sort of look at this, how often do you think a person personally gets in there and makes changes? Do you see people, at the beginning of a plan year, at the time of their compensation is evaluated? Do people typically get in once a year or so and adjust their contribution levels, or is it something that people tend to forget about?
Thanks, Pete. Unfortunately, people probably don't go into their accounts as often as they should, and even an annual checkup is not a common occurrence. So helpful reminders of remembering to check in on their account are useful for most participants. And your question before about automating helps to make sure they are increasing their contributions over time, because most of us just kind of forget and time goes by so quickly. So it is helpful just to keep reminding people and hopefully automating that process for them.
Yeah, Marie, our industry did something for 20 or 30 years. We had these hit the match campaigns, right? We always want people to hit the match. And by the way, I want everyone on this call to contribute at least the same amount that their employer is willing to contribute. But at the same time, culturally, we've gotten stuck there, that some people don't get over that threshold. When you get a raise is an interesting time to reevaluate it and get north of that match. Do you find a lot of people still get stuck at that match?
Absolutely. It's the one thing that people will save towards and think that they've hit the magic number. I've hit the match, I'm done, I got where I'm supposed to be. But I think, for probably every one of us on here on the panel, but I know particularly you and I, Pete, because we've talked about this before, is we do max out, but we didn't start there. It wasn't easy. It was when you would have an increase or something that you could add that 1% and kind of do it, it took years to get to that point. And so many people will get to the match, they'll stop. And then when you try to, talk about, well, let's take the next step, it's very hard for them to put that back in motion. Whereas if they keep it in motion and increasing it, all of a sudden they get there and they're like, wow, this is great.
Yeah, Andrew, I'm going to get to you in just a moment, but one last thing for Joe. Joe, sometimes people forget on their 50th birthday that all of this changes, that hard work of normalizing the max changes, and that they need to change to help us understand what that moment is.
Yes, so thank you, Pete. At age 50, there is a rule in place called the catch-up contribution, where limits go much higher for us. And currently in 2021, that limit is an extra $6,500 that you can save inside of your employer's retirement plan. And that's a big jump from the current $19,500 limit for everybody under age 50. So reminding folks to take advantage of that is very helpful, and does give people who were probably not saving even to the match or above the match early in their career an opportunity to hopefully start to make up some of that lost ground.
You know, Andrew, the intersection of having a healthy retirement plan and wealth management, in my opinion, often revolves around goal setting. That
Correct.
These contributions are not just a drop in the bucket, but they are a true means to an end of, I'd like to retire in this month of this year with this much income available. Help us understand how working with a wealth advisor facilitates this process.
Well, yeah, to your point, we do help people set goals, and a lot of it starts with a budget. You know, what are you actually living on? And then what do you need to save? So what income is going to be replaced by Social Security or pensions if they have one? And then also, you know, what are you saving in your retirement plan? What are you saving outside your retirement plan? Are you paying down debt? Will that debt go away? Will your mortgage go away when you retire, or you still have a mortgage? And so thinking through a lot of those things, you know, to your point of, you know, college savings, you know, are you going to have kids? College savings coming in, and what's that number? You know, the budget really is key. So a lot of people hate doing budgets, but it's important, and they hate looking at what they're spending every month on Starbucks, but you know, they feel a certain amount of guilt, but you know, if we can get them to do a budget, it's we're halfway there.
Yeah, I do feel like a lot of times, whether at the beginning of your career or even in your 50s, people don't want to know how much more a month they need to contribute to hit their goal.
Yeah.
But that's what's needed. Like, I feel like everyone should at least know what they're aiming for. It's one of these weird cultural things we do. And before we were all counting calories, and calories were on menus and calories were on the back of packaging, we just ate what we ate and sort of dealt with it. I feel like the reverse is true for retirement savings. Like, hey man, I'm just putting away when I'm putting away, and there's really no math involved. No. There's a lot of math involved. And if you talk to a professional like yourself, you can work backwards off that math. That actually makes your life easier.
Yeah. And so a lot of times people will look at it and say, okay, the 4% rule. So if you need $50,000 a year to replace your income, you know, simply just take 25 times that and find out what that number is. And then from there, you can work backwards on the 4% rule. So a lot of times it's not that hard. It's the same thing with weight loss. Is how do you lose weight? You eat less and you work out. But a lot of times people want the Atkins diet, or they want the keto, or, you know, the paleo diet, or whatever the hot fat is. But a lot of it's kind of simple and boring. And so saving money, paying down debt, you know, looking at your budget and making goals is the way to go.
You know, Joe, there's so much to think about here, from setting your goals at retirement, and then you get into like what specific investments you should choose within your retirement platform. What I enjoyed about our industry for the last several years is for people that maybe don't want to take the time to build a portfolio for themselves, there's some built-in options within retirement plans, within most retirement plans. Talk to us about sort of those all-in-one solutions in the form of a target date fund and how appropriate they are for most people. You're muted. It's okay, but you are muted.
We can't hear you, Joe.
Thanks, Pete. Definitely, we want to make sure that we simplify the investment solution for most folks. You know, looking at our, you know, what you're talking about today, reset versus, you know, what we just went through as an economy and such, not having to focus on all of those outside influences in your investing is certainly helpful for a plan participant. And as you mentioned, target date funds are a great alternative because they give an instant diversification to a participant's investment selection, and they also help them get more conservative as they get closer to that magic age of retirement. So anything we can do to, you know, automate the saving process and certainly help on the do-it-for-me approach to the investment process are good solutions.
Yeah, Marie, we talked about it during the event. Is, you know, you've sort of got three elements to your financial life. You've got your present, which we all understand, right? You get paid and you deal with your lifestyle. You've got your future, which we're all trying to, you know, get our heads around today. You've also got your past, which is debt. Talk to me about when someone grabs from their future in the form of a retirement plan loan to try to solve a problem with their present or their past. Talk to me a bit about sort of the impact of that and how, yes, you're paying yourself interest, but it's not that simple. You really are potentially delaying being able to hit some of those financial goals in the future.
That's absolutely true. What you lose is the compounding of the value of the money that you have in there. So when you've taken money out, you have less money now that is growing for your future. And people think it's so easy to use their retirement plan as their bank. They want to pull the money out, and they think, well, there's not much effect. I am earning some interest, but if you're paying yourself 2% or 1% interest right now, but if you had it in the market and you might have earned 6 or 7%, and that 6 or 7 continues to grow every year and compounds on each other, the numbers are dramatically in the future. There are some studies where they've shown if you start young and you save for about 5 years and quit saving, and then you delay it for the 5 years and save the rest of your life, you won't get to the same numbers. So it is a dramatic effect. People should never touch their retirement plan unless they absolutely have to. You should. And interest rates right now and loans are so cheap, you're much better off going to a bank and getting a loan and keeping your retirement for your retirement.
Yeah, Andrew, Marie just made a really important point here. Keeping your retirement for your retirement. Sometimes well-meaning people, really loving parents, you know where I'm going with this, will grab from their retirement plan to do all sorts of things, from pay for college to gift their kids down payment for a home. And sometimes it's hard to remember that you can't borrow for retirement, but you can borrow in other vehicles for college. Help us understand how a person's supposed to balance their need or desire to pay for their kids' college and funding their own retirement.
Well, I think it comes back to your point of goal setting. Is a lot of times people don't plan, and when you fail to plan, and it happens, then it's an emergency. So, when you're looking at paying for college, obviously, or even gifting or borrowing home equity loans, or other savings are really the way to go. I mean, if you can plan and say, okay, I'm going to have this expense in the future, let's save it and plan for it versus let's borrow for it. But a lot of times people have trouble separating their current self with their future self and saying, 10 years in the future, I'm going to be retired. They have a hard time imagining that and, wanting to have that pot of money. And so sometimes like the fail to plan on actually saving is the most difficult part.
Andrew, I can't go anywhere or talk to anyone or open my email without someone asking me about the shiny nature of cryptocurrency and all of the exciting types of alternative investments that are out there right now. And I don't know, maybe I'm old school. I view it all to be quite the distraction towards people's more reliable and sustainable financial strategies. How much do you think these, I guess what we'll call alternative forms of newfangled investments? Nothing makes me feel like an older guy than saying these newfangled investments. How much of a distraction do you think these are to people right now?
I mean, a big distraction. I mean, a lot of times last year, people were staying at home. And let's say working from home and there's no change in your income and you're still receiving a stable income and maybe you get a stimulus check. There's no sports on TV. There's no gambling. There's no betting. And so sometimes people are looking at other alternative sources of entertainment. And so some of that was cryptocurrency or GameStop or AMC or whatever the new stock was at the time. And they were looking at their friends, and their friend came over and said, I just doubled my money in Bitcoin. And so probably 95% of the people I talk to don't really understand what any of these cryptocurrencies do, other than they're going up and they don't want to miss out. So it's the FOMO, the fear of missing out. And so there is some utility to them, whether it be a store of wealth or, different uses for them, but a lot of it's just speculation at this point. So, if you want to play with some of your money and say maybe 3 to 5% of my allocation is going to go to crypto, and here's why. But even looking at Dogecoin and some of these that were, completely made up and they're going up in 1,000-fold, it's hard not to want to jump in.
Well, Andrew, I'm going to ask you a question and then have you pass it back to your team as I thank you and the entire Sikich team for welcoming me here today, Marie and Joe and Andrew. I appreciate it. Andrew, if people want to take time, as they should, to talk through some of these issues, these stability issues, to put that plan together, to rip off the Band-Aid, have the conversation about goals and budgeting, what is the best way for them to get a hold of you and your team? And tell us a little bit about that process. Like the radio caller says, I'm going to hang up and listen. So thank you, and take it away, Andrew.
No, thanks, Pete. You'll receive a handout today. It'll have each of our contact information on there. If you want to simply give us a call or email, feel free to reach out. We can talk through some of the financial planning goals. So if you have something in your life where you want to talk through, your income, what you're saving right now, what kind of debt you have, what your budget looks like, we can talk informally, or we can talk through a financial planning arrangement, or simply help consolidate IRAs or 401ks, or discuss what you're saving in your 401k. So more than happy to have that conversation. We do this all the time, so there's nothing that's going to seem weird or outlandish to us. So happy to have those kind of discussions. Simply reach out, and from participant side, Marie or Joe, do you have anything that you would add to that?
Thank you, Andrew. Really appreciate everyone's time today. And as Andrew mentioned, we're really here to be a resource for you. Obviously, there's no charge to have a consultation with us, and we're happy just to sit down. And if you're an employee and you want us to look at your employer plan and just give you some guidance there, we're happy to do so. If you're just someone who is saving and retiring and doesn't really belong into a corporate plan, but just wants some help with your savings and investment guidance, certainly our team can help you with that as well. So thank you again, everyone, for your time today.